something so that you guys could say, okay, I understand it. I want to break this down for you in a way that you can teach it. Because it is now more important than ever that you teach this in the media, you teach this with your customers, you teach this with your with your referral sources, because real estate agents need you desperately right now to help them. So do your clients, because if they don't listen to you, they're missing out on the greatest opportunity that there can be in real estate right now. This is it right now. I'm going to break all that down for you. And taking this message and using something like the amazing Josh Pitts to show you how to make posts of this and how to get this word out to the masses, this is exactly the market you want. So listen, let's get right down to it. So first of all, what I want to explain to you is, and this is something you think we've learned from day one, what drives mortgage rates? Should be, I know somebody knows the answer, good, very good. So most people in your industry do not understand what drives mortgage rates. The media certainly doesn't understand it. Your realtors have a tough time with it, and your clients, oh, it's the Fed, the Fed's hiking mortgage rates. No, the Fed doesn't have anything to do with mortgage rates. Well, it's government control. It is not. Here's the one thing that controls mortgage rates: inflation. Inflation causes mortgage rates to rise or mortgage rates to drop. So, why is that so? Let's break it down so you understand it. Let's use some easy numbers. Say that you're in the business of loaning money. So what you do is you have a pool of assets, then you loan that money out in mortgages, then you take those mortgages, you sell them, and then you replenish your pool, and then you can go out and do more mortgages. Everybody understand me so far? Give me a yes. Okay. You give me a mortgage, and that mortgage, let's call it, it's $400,000 mortgage, and I make you a payment of $2,000 a month. For the most part, it's going to be a fixed payment. Like 90% of loans are fixed, and even on the rest of them that are ARMs, the vast majority are hybrid ARMs, so that's going to be fixed for a long time. You get a check this month that says $2,000 from me. You go out and you buy a shopping list of stuff, goods and services for $2,000. You get everything on your list for exactly $2,000. Next month, I give you another check, and you get everything on the list. But over time, you discover, hey, man, I can't get everything on my list anymore. And the reason is because of inflation. Inflation, things start costing more. So, hey, wait a minute, where it used to cost me just this much, now each item costs more, so I can't get everything on that list anymore. The check still says $2,000 that you get from me, but it doesn't feel like $2,000 used to feel. Does that make sense? So, you can't do anything about the loan you gave me already, right? That's done, you've sold it. But on the new mortgages that you do, because this is what you do, you have to contemplate that. You got to think about the fact that, hey, inflation's making prices go up. The buying power of the fixed payment that somebody's going to receive on that, the investor's going to receive, is going to be whittled away. It's going to erode more rapidly. So what's my only defense? What do I have to do so I can sell that mortgage? You have to say this confidently, folks. Listen, this is the most important thing, I think, in communication with your customers is confidence, okay? If your customer says, well, what's going to happen with rates? Well, you can't do that, okay? What's your only defense if inflation starts eating away? How are you going to make that mortgage saleable to somebody else if they know the fixed payment's going to be eaten away more rapidly? What do you tell them? I'm going to raise what? Raise the rate. So now instead of you getting for another $400,000, $2,000 a month, maybe you get $2,300, $2,400, $2,500 a month, and it offsets the more rapid rate of inflation. Is that clear? Because it's important we understand this, because these are building blocks. So if we understand that, then when inflation was at 1%, we had the ability to offer interest rates very low because the erosion was very low. But now inflation's moved up significantly from then. So what do lenders have to do? What do investors have to do in order to make those loans saleable so people have an appetite to buy it? They have to offer a higher interest rate to offset that more rapid rate of erosion. So if I were to say to you, if the customer were to say to you, when will mortgage rates come down? The answer is when what comes down? Yes, very good. Okay, so now let's start off, because I don't want to make any assumptions, is what is inflation to begin with? What's inflation? Here's the definition of inflation. Inflation is this: it's too many dollars chasing too few goods. Too much money sloshing around out there. Too many buyers, not enough inventory. Just like in housing, When you had a flood of buyers, a little bit of inventory, what happened to prices, everybody? It inflated higher, yes? With anything. If you're super thirsty, and everybody in this room was super thirsty, and there was only a couple of bottles of water that were for sale, last couple of bottles of water, everybody wanted it, what do you think happens to the price? Starts to bid higher. Remember toilet paper? Okay? So this is what starts to happen. That's inflation. So when the Fed comes in, they says, we want to fight inflation, what do? The Fed has a very blunt instrument. They increase interest rates. Okay, so what does that do? You increase interest rates. How does that fight inflation? Because while they don't affect mortgage rates, a hike in the Fed funds rate affects things like personal loans, credit cards, home equity lines of credit, which are based on a variable rate based on the Fed funds rate, and car loans, commercial and industrial loans. Now imagine this. Imagine a business. They say, well, I want to build a factory, $500 million. The Fed funds rate, who knows what the Fed funds rate is right now? Whoa. Okay, team, listen, I want to give you some tough love here. Okay? First of all, you say you're in the mortgage business. I know that, but is your product sucks, right? I mean, who wants a mortgage? Does anybody really? Mortgage is death promise. That's the definition of mortgage. Yeah, I sell death promises. You know that? Look up the definition of mortgage. Mortgage means I'm in debt. Mortgage means I've got a high monthly payment. Nobody wants that product. What do they want? What are you selling? You're selling money. Money so I could purchase a home, so I could finance a home, so I could create wealth. If I use that debt wisely, I could create wealth with it. That's what you do. You're wealth creators. Your product is money. Team, the price of money is the Fed funds rate. That's the most important price in the world. And you're in the business of money, you need to understand this. Fed funds rate today is target range of 3 to 3.25% as of today. It will be going up on November 14th by 0.75%. So let's call it goes to 4%. On December 14th, November 2nd, it's going to go up, by 0.75%. December 14th, it's going to go up another probably 0.5 to 0.75%. So it's going to approach 5%. The Fed funds rate was at 0 at the beginning of this year, first quarter of this year. So think about this. If you're going to be building a new factory and you want to borrow $500 million to build that factory, when the Fed funds rate's 0, maybe you're paying 2 points over that, so you're paying 2% on $500 million. Things might change if it's now 2 points over a Fed funds rate of 5, right? So that will give you a 2% rate I'm paying on $500 million versus 7%. What might happen? You might not decide to do it, right? And that's exactly what the Fed wants to do. The Fed wants to do something called demand destruction. They want to take those dollars out of the system. Think about going to buy a car. Can you walk into a car dealership and walk out with a $50,000 car without spending $1? Can you? Yes or no? Yes, of course you can. You sign a piece of paper, you drive. So, did the seller of that vehicle get $50,000? Of course they did. So $50,000 got created out of thin air. What's inflation, everybody? What's the definition? Too many dollars, chase it. So when money is cheap, a lot of people want to buy it. That's a lot of dollars sloshing through the system. Now, what if, because the Fed's hiking rates, if back 6 months ago you went to go buy that car and the payment for a $50,000 car were $600, you might do it. But today, and maybe towards December, it might be $1,200. What might that family say? Family might say, hey, you know what, I'll keep the car I have for a little bit longer. And even if they wanted to, they may not qualify any longer, right, for that car loan. So what's the Fed doing? By making it more expensive, that's less money in the system. Look, we run on credit. For every $17 that you see that's money, 16 is credit. Imagine if you were limited that you can only buy what you have in cash or savings. Think about, would your life be different? Most people's life be different, wouldn't it? Yes or no? Yeah. So therefore, when we take a look and say, okay, we run on credit. What the Fed's trying to do is make it much more expensive so that there's less money in the system. And by doing that, it brings down inflation. So the Fed hikes, some money goes away. Now, what about savings? People haven't been saving of late because you go to the bank and it's like, what am I going to get, 0.02, nothing. It is scientifically proven that human beings, if the rate of return that they get is less than 2%, that rate of return means that they're not incented to do it. They would rather not do it. They'd rather spend it than save it. They'd rather put it in something speculative than save it. That's why you have all these little assets, Dogecoin and all this shit that goes crazy, okay? Because money's so cheap. People aren't saving it, they're looking for crazy investments. When you take a look at interest rates now moving higher, people have an incentive. Look, there's something called a risk-free investment. What's a risk-free investment? The 6-year Treasury, the 1-year Treasury, the 6-month Treasury, pardon me, the 1-year Treasury, that is completely risk-free. Why? Because it's backed by the full faith and credit of the U.S. government, so you'll get your money back. But you might say, well, Barry, so is a 10-year Treasury note or a 30-year Treasury bond. Yes, but there's risk because it's so long dated that if interest rates go up or down, the value of what you have in between might go up and down quite a lot. You might not hold it the entire 10 years or 30 years. But because the 6-month has such a short duration, or the 1 year has such a short duration, it doesn't matter if interest rates change a little bit because you'll still get back your full principal within a very short period of time. Here's a risk-free investment right now. 6-month Treasury, you're getting over 4%. Do you know as of the November 2nd rate hike, you'll probably get 4.5%, 4.75%. As of the December 14th rate hike, you'll get more than 5%. It's a great investment. I'm waiting personally for December 14th when we get that rate hike, and I'm going to put some of my assets in treasuries, 6-month, 1-year treasuries, because it's completely risk-free and it's a rate over 5%. That starts to look pretty good. So if I'm not the only one looking at that, and you might be looking at that, by the Fed hiking rates, then what happens? Some people do what? They save instead of spend. Excuse me, this went a little far here. The money goes into the bank, so it takes money out. Plus, we are seeing a lot of more goods flowing in. Remember COVID lockdowns in China, supply chain disruptions. So goods are coming back. So you have fewer dollars, more goods. What's inflation going to start to do, folks? It's going to slow down. Now, let's take a look at the relationship between mortgage rates and inflation. The bottom line on the left is mortgage rates. It's kind of a bluish tint. The pink tint there, the bottom line is inflation, pardon me. The upper line on the left with a pink color are mortgage rates. Notice that when you take a look here, when inflation started to go up, mortgage rates started going up. When inflation started coming down, mortgage rates came down. Inflation was flat, mortgage rates were flat, until this period here called QE, quantitative easing. That's when the Fed started buying enough treasuries and mortgage bonds to keep mortgage rates around 3%. If you take a look, they did a pretty good job because mortgage rates stayed right around this 3% level for that entire QE period. Do you all see that? Now, they fixed the game. They rigged the system because what started happening, look what inflation started to do. You see inflation made this big skyrocketing move here and then here. Well, when that started to happen, what did the Fed tell us? Don't worry about inflation because it's transitory. So the Fed really screwed us here because what the Fed did was they left us with no good choices. That's like, imagine a patient, they start to show symptoms of getting sick, maybe they've got the flu or something like that. If the doctor does nothing, says, oh no, don't worry, it's fine, it's transitory. And then that patient gets really, really, really sick. They might need surgery, they might need whatever, right? God forbid, bad things happen. Well, now our country's in that position. Now we need very, very invasive surgery because they didn't pay attention to the warning signs early because the Fed was asleep at the wheel and they screwed us. The reason why you're looking at 7% rates, the reason why you're slow in business right now, and the reason why your customer's in this position is because the Fed was asleep at the wheel. When we take a look at what happened is eventually they took the training wheels off, and look what happened to mortgage rates when they stopped QE. The second they did, what did mortgage bonds do? They did what they always do. They followed inflation. Inflation went up, mortgage rates went up. Inflation came down, mortgage rates came down. Inflation went up, mortgage rates went up. Does that make sense to everybody? Do you see the relationship between the two? I'm glad you do, because this is the way you calculate it now. Don't look at this chart and tell me, oh my gosh, Barry, that looks a little crazy. Looks a little complicated. Look, I promise you, nobody came out of the womb and said, oh, I know what CPI is. Okay? These are all learned behaviors. This is not that complicated. Let me break down how inflation's measured. There's two reports. There's the CPI, Consumer Price Index, and the PCE, Personal Consumption Expenditures. They both kind of do the same thing. I like CPI better because what it does is it measures more out-of-pocket medical expenses and cost of shelter. The PCE comes out a couple of weeks later as well. So the CPI, I think, is better because we get it fresher, okay? So we can see what's really happening. By the time the PCE comes out, we already know what happened. So with the CPI report and the PCE, there's two components. There's a headline component, and then there's a core rate. What's the difference? Does anybody know the difference? Very good. Somebody knew. Everybody should know this. The core rate takes away food and energy. Now, somebody might scoff at that and says, oh, well, I need food and I need energy. Well, yeah, we know you do. But when the Fed looks at it, the Fed can't influence food and energy, can they? The Fed can hike rates, cut rates. It's not going to affect weather conditions for crops, okay? The Fed can hike rates, cut rates. It's not going to affect what OPEC does for energy. You follow what I'm saying? So the Fed's looking at what it can influence. So that's the core rate of inflation. And today in the United States, on a year-over-year basis, the core rate of inflation is at 6.6%, and that's just way too high. So we need that to come down. Well, how do you construct the core? How do they figure 6.6? Well, interestingly enough, while 6.6 is for the whole year, it's made up of 12 individual monthly pieces. It takes the most recent 12 months. So if you see to the extreme right, you see September, and it goes all the way back to last October of 2021. So these 12 numbers added together account for a little compounding and rounding, and you get 6.6%. Are you with me? Yes, good. Now, many of you know, in the spring, there were a lot of people who were saying, inflation's peaked, and we said, bullshit, no way that's peaked. And if you listened to us, and if you watched our updates, or you heard me speak, I pointed to these 3 months, and I said it's going to be a brutal summer. We even used Cruel, Cruel Summer, that song, on one of our updates that morning. So we said, listen, we're going to have heartburn, the summer's going to be brutal, it's going to be tough. And everybody said, okay, okay. It's one thing to be warned about it and know it's coming. It's another thing to live through it, okay? Right now we're living through it. And this is the problem, is that even though we said there's going to be heartburn, it's going to be tough, living through it is a whole other experience. You can be prepared for it, but now we're going through it. But the good news is this is exactly what we expected and exactly what we told you was going to happen. Now, the second part of that is that we said once we get to the October reading, that comes out on November 10th, we think inflation starts to come down. Why? Because these comparisons are much more elevated. Look at the comparisons here. We should start to see, because of the Fed hikes, because of the slowdown, because of the goods flow, we should start to see inflation come down on a month-by-month basis starting November 10th. And then when you remove, now remember, when November 10th comes, that's going to come with October 2022. October 22 replaces October 21. So because we believe these numbers will be lower in the future, the overall year-over-year now starts to come down. Because if we replace it with 0.3, replaces 0.6, then this goes from 6.6 to 6.3. Maybe the next month it goes to 6%. Maybe 5.8, 5.6. You get the picture here, okay? And when inflation starts to come down, what do mortgage rates do, everybody? There you go. Now, of the core rate of inflation, shelter makes up a big chunk. It makes up 39%, 39.3 if you want to be exact, but 39%. This is the core rate of inflation of shelter. Look at this month of January here. Remember we said we had to get through that? It was that low point we had to get past? The low point here is January. So while we see inflation coming down, after January's report, remember we get it in February, we think inflation really starts to come down. Look at rents and shelter. Do you see this loop here? Over the past year, it was going up, 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 till it hit in the peak in January. And then it started to come down, inflation, okay? It looks kind of like this, like a roller coaster. So on the right of the roller coaster, coming down, is shelter today, where we really are in real life. But what the Fed's looking at is to the left, which is that year-over-year number that's in the CPI report. Just like when you're in the roller coaster, you're still going up if you're in the back, but the people in the front, they're already headed down. Real life is heading down. But the Fed sees it as going up. That's why the Fed says, oh, we don't see any benefit to inflation, because they drive with their eyes in the rearview mirror. Very dangerous. In January, we reached the peak. Remember, we get this number in February. The roller coaster starts coming down. Now, there's something else called money supply. By March, the excess money supply starts to get more neutral. So I am telling you that in the first half of next year, I think if we get lucky the first quarter of next year, first of all, starts to get better towards the end of this year. Sometime first half, maybe first quarter, we see 5% mortgage rates. Right around 5, maybe less than 5. That changes the ball game. I can't believe I'm going to say this, but I'm in this business for a very long time. I'm in this business 36 years. Holy shit. Okay? So I have seen a lot of markets. I'm just like you. I know what it's like to start at the beginning of the month at 0. I'm just like you. I know what it's like to have tough conditions. Refis go away. I've seen it all. Trust me when I tell you I've seen it all. The one thing I've seen that's really bad is I've seen people give up right before it turns. Not that long ago, 2018, things started to get rough. The housing market was rough. Rates went up. How many of your colleagues left the business? And they left right before the greatest market in history. I saw it happen in 87, in 88, in 89, and 90. I saw it happen when rates were, believe it or not, I'm going to go way back, in 1985 when they were 13, 14%, and then when they came down to 10, it was a refi boom. I know that sounds crazy, but yes, it was. But also, I saw in 2008 and 2009, and some of you might remember this, in 2008 and 2009, remember the implodometer and all the shit that was happening, and they left the business right before the greatest 10-year run that this industry's ever seen. They got out right before. Please, please, please do not make the same mistake. I'm showing you this and explaining to you that things are going to get better. We have a Fed chair that doesn't understand inflation, admittedly, okay? But I want you to be able to understand inflation. Now, recessions are important to understand. I'm very, very proud of the